Welcome back to our Chapter 6 discussion on inventory and cost of goods sold. This video picks up for an illustration of what we are going to be covering in the different inventory methods. So now we have Hazelwood surplus began March with 75 tenths that cost $16. So this is our beginning balance in inventory. And during the month, we made 3 different purchases at 3 different price points, as you can see here. So we sold 318 tenths, and at March 31st, the ending inventory gave us 52 tenths, and the sales price is $45. So we want to determine the cost of goods sold and ending inventory amounts for March under the average cost, the FIFO, and LIFO, and we want to round to 2 decimal places. So since we're not doing anything with revenue, this information is extra to confuse you. So because what you need is the beginning balance and inventory, the purchases and sales, and then your ending balance is given. You can also compute that based on the information. So let's start. So right now we have our beginning inventory. So this is excellent in Excel. So I would highly recommend you use the Excel template that I provided you, and make sure you understand the formula. So that's our beginning balance. And then we added each of our each of our purchases to get goods available for sale. And then we're going to determine cost of goods sold and ending inventory balances. So these items right here, we need to know based on what the cost is going to be, whichever inventory valuation method we use. So we have our information here, 3 tenths sold, 52 in inventory. So this is what we have. This is our goods available for sale thus far. And now when we're looking at that, for average cost, we take each of these. So we're adding up these numbers to get to the 370, and we're adding up their extensions to get to the 6945. So this is our cost that we're going to use for both inventory and for our cost of goods sold, as you see here. So, and we end up with the same balance in both because we have 318 left. And that's just coincidental, so don't let that throw you off. Now for FIFO, remember that is first in, first out. So we sold 318, so the first in would be our beginning inventory. So that is part of our cost of goods sold. Then we have 95 units. That's still not enough to get us to the 318. And then of the 165 units, we only need 148. Do not get confused and make a mistake of just carrying this over. So now once we do that, we know what we have left. So see, each of these units is extended. So here we're just adding up this amount to get to our 58, and that's our 318 units. And then our 52 units is here at 1,075. So now we're doing LIFO, last in, first out. So in this case, to get to our 318 units, this item moves over first, our 35 units here. Then we sell completely our 165 units. And then lastly, we still need our 95 units here because this yet does not add up to 318. And this is why I recommend Excel with these different numbers that you can't really do relatively quickly in your head. It helps you to use Excel. So of the 75 units, we only need 23. So we know that our 52 units are going to be valued at the $16 because that's what's left. So basically what we have is we did all of these extensions. So this is our cost of goods sold for the 318 units. And then we have our 52 units at the $16. So this is a great summary. I would recommend you add these formulas to your Excel template because this will help you answer. When you have numbers, it'll help you answer which inventory method on your exam has the highest value of ending inventory. And you would note it is FIFO because, again, the last items purchased are still in inventory because the first item purchased are in cost of goods sold. And then notice how your goods available for sale is the same in each inventory method because this is how many you purchase. You can't change the valuation of the purchase because you bought it for a particular price. So that is the same. So what you care about is the ending balance in inventory and the cost of goods sold. And notice that LIFO gives you the highest cost of goods sold and the lowest inventory value. And this is what gives you the tax shelters because if you have a higher cost of goods sold, you have lower net income. So now what we're going to move our attention to is those effects on the balance sheet. and the income statement. So here you see exactly what I just mentioned. So for FIFO, COGS is the lowest, and for FIFO, ending inventory is the highest. And if you look, you see that relatively quickly with just these examples. So if you have this in your, if you have this in your Excel, then you can answer those questions relatively quickly than trying to remember all of these pieces. And then as we discussed, LIFO, the cost of goods sold, is highest, and the ending inventory is lowest. So it's just quite easy to do that when you're looking at numbers. And then when inventory cost, and I didn't mention here, this is when costs are increasing. So the opposite effect takes place when costs are decreasing. So then you pretty much have the same item there and the same item there. So I think it's just easier to do with numbers, but whatever works for you. Now going back to our perpetual inventory, it's impossible to apply LIFO units to units purchased and sold as transactions are happening. And so just weighted average can be a bit of a challenge because you need to make sure you're doing this in computer software. And then many companies track inventory quantities during the period. And then what they do is they make an adjusting journal entry at the end of the period to either LIFO or weighted average. So now with the advancements of technology, your accounting information system, another acronym for your Excel, basically can do all of this for you. So they would give you that information. So we mentioned previously that the advantages of LIFO is that when the prices are rising, you have lesser income, so you pay lesser taxes. And then when you compare the two, which is pretty much what's happening here, FIFO gives you a more up-to-date inventory cost, more like replacement cost, right? Because those are the items you purchased last. And so more likely than not, if you're going to need to purchase more, it would be closer to those amounts than previous amounts. And then LIFO gives you more of a realistic net income figure, because then you're saying what's in cost of goods sold is truly what the price of the cost of the goods are now at this moment in time. So LIFO and managing reported income. So at this pace, what we're doing here is manipulation of income is illegal. You can manage earnings, but through legal measures, but not manipulation. So if inventory prices are high, then large quantities are purchased at the end of the year to lower your taxes. That is not possible. Liquidation, actually, quantities that have decreased from last year, they may dip into older inventory levels. So these are ways that you can report income. And LIFO, as I mentioned earlier, is not allowed for international financial reporting standards. So the fact that we want one global set of accounting standards is very remote at this point, unless we're able to give up LIFO in the US. So now let's move on to our third learning objective, where we're going to apply GAAP to inventory. So we have to disclose in the financial statements enough information for reasonable decision makers to make those informed decisions. So then usually that's done through the notes to the financial statements. And a financial statement package is not complete. You have to have the financial statements, which we know are the income statement, the statement of retained earnings, the balance sheet, and the statement of cash flows prepared in that order, plus the notes. Gives us a full set of financial statements. And then what the accounting principle says is that you have to represent faithfully the information. So it should be relevant and it should be represented faithfully. And basically, which means you should disclose the information. In the notes, you have to say which inventory method you use, whether it's FIFO, LIFO, weighted average. And then if there is a significant, which is material, how we term it in audit. And remember, materiality is based relevant to the company. If you have $10 million in inventory, $1 million is material, possibly even $500,000. But if you have, $100,000 in inventory, $1,000 may be material. So you do have to disclose that. And then consistency basically leads us into that the financial statements to be comparable. So these principles are known as the Statement of Financial Accounting Concepts. Statement of Financial Accounting Concepts. And that gives us our conceptual framework. framework, which basically are these qualitative characteristics like faithful representation, consistency, comparability, that says we should be able to, any person should be able to consistently go from one year to another and make sure that everything was recorded in the same fashion. And then the footnotes should tell us the inventory method, and the inventory must be valued at lower of cost or market. So lower of cost or market, meaning that if it cost us $4 and the market is $5, we report it at 4. Always lower to be conservative. And so let's talk a little bit about the lower of cost or market. So at this point, we are required to be reported at the lowest amount, and usually it is cost, honestly, because when you buy something, you're purposely buying it to sell it for more. So what the market value does, it's basically the market value tells you this is what if something's it's going to cost you to replace. And if the replacement cost is below the actual cost that you pay, then what you have to do is write down. So you have to write down the inventory, and usually you debit cost of goods sold. Oops, let's go back. Sorry about that. You debit cost of goods sold and you credit inventory to write it down. So let's look at an example. And here we're back to Family Dollar, and we paid $3,000 for inventory on June 26th. By August 25th, which is their fiscal year end, the inventory can be replaced, but now we're talking $2,000. So Family Dollar's year-end balance sheet must report, note must, that is GAAP, the inventory at lower of cost or market. So we need to make sure that it is $2,000. So to write this down, what we do is we debit cost of goods sold and then we credit inventory. So we will, and then basically what we have here is the inventories at market, which is lower than the $3,000 cost. Normally you may not see this on the face of the financial statements. This would probably be in the notes. And then you see your cost of goods sold, adding the $1,000. Again, this information would not be visible. This is only here for your understanding. But when we report out, we would not go ahead and do that. Okay, so this is going to end this video on our Chapter 6 discussion.